that I want to cover for today's session is about the treasury bonds. So, so when we talk about the US dollar, a lot of eyes are on the treasury bond situation. But of course, before we do that, let's take a quick peek on what's happening on the Forex Factory calendar. So let me just share the screen, and here we go. All right. Okay, so what's up? What's up coming next on the Forex calendar? We have a bunch of, next week is a little bit of a heavy news week. So you can see a lot of great news coming out. We have on Tuesday, CPI figures, all right? On Wednesday, we have GDP from the UK side. We have more economic, we have FOMC on the Thursday, federal funds rates on Thursday, all right? So this will be interesting to keep an eye on. And of course, we have a couple of other, I think the Euro monetary policy statement would be interesting to just put an ear to. Australian unemployment rate is over there. So next week's a little bit news heavy, which does give us an opportunity to find nice pops of currency pushers, right? While we don't really trade the news, we can actually position ourselves to see whether we can take advantage the volatility that's in the market. So one of the key I would say sentiment that's been going around in the market right now is about the bonds, right? US interest rate is currently at 5.25%. There is talks of targets hitting 6% in the near to medium future. This is an article I'd like to share with you guys over here. All right, so this is an article that came out about maybe sometime earlier last week. It talks about the Treasury's 1 trillion debt, that could threaten the market. Essentially, if you can just go Google, this article, and it's on the Wall Street Journal. So basically, the summary of this article is it really talks about what does it mean for US Treasury yields to have so much of debt in the market. So this is where the US Treasury yields are at right now. Short-term, 3-month short-term bonds, are about 5.25. This is where the Fed funds rate is kind of pegged at. 2-year notes are about 4.5%. There is a little bit of a jump as comparatively to the last couple of months. Treasury Department is rapidly trying to replenish its so-called coffers, and it is about while it is kind of interesting to have such high bond prices, what does it mean for interest rates as a whole in the US market, right? Because at 5.25%, 6% interest rates, if you translate it, if you pass on the cost down to consumers, it would mean that it is more expensive to take a housing loan. It is more expensive to take a car loan. It is more expensive for businesses to borrow money to expand their business, right? And that is what inflation has done, is made things more expensive. And what the government is trying to do is trying to cool down the economy by increasing interest rates so that people don't spend as much. Therefore, they can't borrow as much money to expand their businesses. There's less transactions going on because it's too expensive to. But however, it is a double-edged sword, right? Because things are already so expensive, and what the government is actually doing is making it even harder for those at the lower tier of the income band to kind of survive, right? And that is why their focus is really to push down inflation, but increasing interest rate is actually a double-edged sword. So who benefits in this world of high interest rates is the bond market. If we look at the US 10-year yields, let's go and look at a couple of the US bond yields according to their years, just to see what it means to have that interest rate disparity. So over here, I have the 10-year yields. All right, 10-year yields touched a 3.81%. This is a daily time frame sometime last week, and it seems to be holding in this area. If we look at the US 5-year yields, all right, you can see a very similar price pattern. All right, it's also, this is 10-year, this is 5-year. You can see that I'm just toggling both right now, and you can see that the yields have a very similar translation, because that's how bond markets move, right? They move in accordance to the 2-year, 5-year, 10-year yields, and everything just kind of adjusts together. So the higher interest rates are right now, it means that the 10-year bond interest rates will be higher as well, just that it's not as high as the short-term rate. So short-term interest rates will always be a little bit higher as opposed to the yields in terms of the long term, because of the fluctuation. So we have US 10 over here, and this is I actually have a US 2-year over here. you can see the patterns are really pretty similar. US 2-year yields at 4.6%. US 5-year yields is about slightly below 3.9 to 4%. US 10-year yields is about 3.8, 3.7%. So the moment the interest band starts changing, all the bond market will start changing. So the question we have now is, in the face of surmounting debt, will the US consider or even think about either stop increasing interest rates, or will they try to top down interest rates? So this is the dilemma we have right now, right? Because on one hand, if we look at trading economics, interest rate has gone down quite a fair, healthy chunk, right? It was, at one point, the last couple of months, let me just click into this. So the last couple of months, it has gone from, if we look at October is about 8.2, 7.7%. The highest in July 2022 was 9.1%. So technically, it's almost half gone, right? We are almost slightly less than half, 4.9%. Okay, so the Fed now has an option. It's either they hold the interest rates for a while more to allow allow the inflation to continue to squeeze in, and because the effect is a lagged effect, right? Meaning that there will be some delay on whatever's happening on the screen. So the 4.9% is not because of the current 5.25% interest rate, it's because of the previous move. So inflation is usually lagged in terms of the data that comes out. So the question is, how much is the government willing to overshoot or undershoot to achieve their target? Because it's already on the downward decline. The government now has an option to either hold interest rates or to consider lowering interest rates a little bit to start moving it back down. And this is what is going to be interesting, because when you start to lower interest rates, what's going to be happening? It's, in a way that is quantitative easing, right? So in a way, by lowering interest rates, we're going to make money a bit more accessible, meaning that the US dollar should start to weaken in terms of, because now it's cheaper to borrow in USD, a lowering of interest rate theoretically is supposed to allow the USD to weaken. But then the government will have to think about, do they want the USD to weaken? So when we look at the US 10-year rates now, I think there is going to be at least a small probability there that in potential interest rates will either hold for the next couple of weeks, and towards the end of the year, instead of popping up to 6%, there is a good chance that they might go down to 5%. Now, why do I say that? It's because it's a double-edged sword. The longer they keep a high interest rates, the more trouble they'll be in. It's just the nature of where the money is going right now, right? So they have increased interest rates so much right now. The longer they keep it at 5.25, even at 6%, it means that the more trouble is going to be coming back in the back end. So it's a matter of how long they want to drag it out. All right. So there is that small probability. Hopefully, if they kind of figure it out that this inflation is lagging, they can't tolerate a 4.9%, 4% inflation rate, then I would think there is a good chance that they will just say, okay, we're not changing interest rates for a while, or we might even pop it back down to 5%. Now, I don't believe they will pop it back down. I think there's a higher probability they'll just hold firm, because the moment interest rate starts to drop, it would mean that there will be consequent drops. They're not just going to drop down and then increase it later and then drop and go up. So traditionally, how the US market tends to manage the interest rates, they don't fluctuate, right? They make a decision, then they start to slowly go towards a certain direction. They don't go up and down one month to the other. So what it means for us as traders is, while the USD might be slightly sideways for the next couple of weeks, the moment the US starts to drop interest rates, is going to be a very, very cool trend coming up. A downward trend is probably coming up for the USD. Now, traditionally, I'm a dollar bull, meaning that I prefer to be on the side of the dollar strength. But if interest rates do come down, all right, I think there will be a chance for the USD to start to mediate towards a certain level. If we look at the USD across the board in the other currencies, I'm going to use the index for this just to see the bigger picture, right? If we look at the USD index over here, all right, over here, it has already come off a fair bit. Okay, despite having a high inflation, it has really come off a little bit because of the sentiment, because of the commodity market, and it is now at a point where I would say that it is kind of reaching. This is 2020, very near pre-COVID area. So it's $99. So I'm looking at the 99. Let me just clean this up a little bit. I'm looking at the 99 region, 99. Okay. Then I'm just going to delete this one. Okay, so if you look at 99, the index, the dollar index at 99, the reason why I'm picking 99 because we are differentiating between pre-COVID, post-COVID, right? So pre-COVID was somewhere around the 2020, 2019 area where currencies were starting to fluctuate. And then before that, you can see the norm is around this area. It's around the 96 to 99 level prior to the COVID period when the economy was, just getting its legs. So if we translate it over to a little bit more here, for the USD to kind of mediate back to the norm, if inflation starts getting back to normal, if interest rates start meandering back to normal, then I think the journey for the USD towards a midline is quite possible. But for that to happen, we need the US to kind of give us an indication of when potentially will they be comfortable and confident to start to reduce interest rates. And then we should possibly be able to target the US dollars towards this area. All right, I mean, there is a ways to go down, right? So I think it's really hard for me to be a dollar bull, even though I want to be, all right, because the interest rates is a very sideways market right now, precisely because of, basically the debt just means that they have such a high debt means they got to pay very high interest because, that's what high interest rate means, right? So it's just a matter of if you're buying a house at 6% interest rates comparatively to 10 years back when you're buying it at 0.25% interest rates, that was what US dollar interest rates are, something has got to give. So what will give? I'm pretty sure, a decision will have to be made soon. There must be some reason why they took so long to decide on raising the debt ceiling. There must be some discussions behind that we're not privy to, but I do believe a slightly clearer picture will come out in the weeks to come as we see the US start to position themselves to, are they going to hold interest rates or are they going to go down? Because the debt ceiling is a very fresh reminder that their debt is a lot, right? It's just purely they are in a lot of debt. They have just hit the ceiling. Do you want to aggravate the problem by continuing to increase interest rates, or are they going to hold firm and try to figure out other ways to cool off the economy, other ways to cool off inflation, other ways to allow the economy to cycle back to a medium, back to the medium? And that is what I'll be looking for in the next couple of weeks. A close eye on the USD, but more towards opportunities for the short side. Not so much because I think US dollar is weak, but because I think of the potential sentiment that is coming out from the USD. I think as governments try to position their bond yields, we should see a little bit more USD being flooded back into the market as governments do their bond rebalancing. All right, so that's where I'm looking at right now. So we'll see what comes up. There is the I think next week there is the FOMC statement. I think the CPI, the CPI would give us an indication, right, to see whether the CPI improves or doesn't improve. It will tell us where it goes. Daryl, you commented when the stock market crashed, maybe it will help bring the USD down. When the stock market crashed, a lot of things will be very volatile. And in fact, I do sometimes feel that if the stock market crash, in fact, the USD will strengthen because the money has to flood to somewhere, right? If you don't want to hold stocks, you have to hold it in cash, or you have to squeeze your money in bonds. So there's no right or wrong. It just which one is stronger? Fear is stronger, FOMO is stronger, or greed is stronger, and that is what is driving the currency market in the world. It's not about. It's very little about fundamentals these days. It's really more about sentiment. Which is stronger, greed, fear, or FOMO, right? And that is something that we have to remember as we trade the forex markets, that while the fundamentals are telling us one thing, let's not forget in this day and age and technology, fear, greed, and FOMO can move markets, all right?